Value investing is a strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Don't be afraid. We are going to explain all relevant investing terms in this video. Investors who follow this strategy look for stocks that they believe the market has undervalued. Understanding value investing. Value investing was popularized by Benjamin Graham and David Dodd in their 1934 book Security Analysis. Warren Buffett, a protege of Graham, is perhaps the most famous value investor. Key financial ratios and metrics. Price-to-earnings (PE) ratio. This is one of the most widely used ratios in investing. It is calculated by dividing the current market price of the stock by its earnings per share, EPS. A lower PE ratio may suggest that the stock is undervalued, but it's essential to compare the PE ratio within the same industry, as different sectors have different average PE ratios. Price to earnings is your price tag for $1 of the company's earnings. For example, a PE ratio of 15 means you're paying $15 for every $1 of earnings. A lower PE ratio might indicate an undervalued stock, but as we said, it's wise to compare this with industry standards. Price to book PB ratio. This ratio compares a company's market value to its book value. The book value is derived from the balance sheet and is essentially the net assets of the company. An PB ratio under 1 could indicate that the stock is undervalued, assuming the company is financially healthy. Imagine buying a company for its net worth. The PB ratio tells you how much you're paying compared to the company's book value. PB ratio less than 1 can be a sign of an undervalued stock. For instance, if a company's book value per share is $20, but the stock trades at $18, the PB ratio would be 0.9. Debt-to-equity (DE) ratio measures a company's financial leverage, calculated by dividing its total liabilities by shareholder equity. A lower DE ratio is preferable for value investors, indicating less risk associated with the company's debt level. A company with a DE ratio of 0.5 borrows $1 for every $2 of shareholder equity. Lower ratios suggest less risk, indicating the company isn't heavily reliant on debt to finance its operations. Dividend yield. For many value investors, the dividend yield is crucial. It shows how much a company pays out in dividends each year relative to its stock price. Higher yields may be attractive to value investors, but it's important to ensure the dividend is sustainable. A higher yield can be attractive, indicating the company is sharing profits with shareholders. For example, if a stock trades at $100 and pays annual dividends of $4, the dividend yield is 4%. Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. A strong, positive free cash flow is often a good indicator of a company's ability to sustain earnings and pay dividends.